Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Today I'm joined by Dan Carrigan, Nasdaq AVP of Strategy, as well as Joe Tigay, Chief Trading Officer and Managing Partner with Equity Armor Investments. Nasdaq introduced a new way to track implied volatility on the Nasdaq 100 index, which includes the largest domestic and international non-financial companies listed on the Nasdaq stock market, reflecting the performance of companies across major industry groups, including computer hardware and software, telecommunications, retail, wholesale trade, and biotechnology, or what we call the modern day industrials. The Nasdaq 100 Volatility Index, ticker symbol VOLQ, measures 30-day implied volatilities expressed by the prices of certain listed options on the Nasdaq 100 index to obtain the prices of synthetic, precisely at the money options. With market moving news seemingly by the minute, what can traders examine to help understand whether a sharp market move is sincere or suspect? For this answer, I turn to Dan Carrigan of Nasdaq.
Thanks, Jill. And this subject is timely. I mean, after all, Major League Baseball playoffs start this week. So what's my reference to baseball? It's actually quite simple. I relate the unknown of the next market move to a baseball player standing at the plate. I mean, that batter has to evaluate before and during the pitch, whether it'll be a fastball, maybe a slider, or a curveball. And just like that batter, we want to hit the ball out of the park when trading. But I must admit, I would settle for single or double. So our game day plan today is to examine whether traders can identify curveballs when standing at the trading plate. I mean, when viewing the trading screens, of course. Here's an example. I would imagine almost every question that comes to the trader first and forefront is, what is going on in the markets? And with every swing or click of the mouse, they're going to ask next, where is the market going from here? The truth is, no one ever really knows the complete answer to either question, but there are market signals and measures we can use to try and get some idea of where market instruments like stocks, bonds, volatility, and indexes are tracking in relation to each other, or simply put, correlation or non-correlation.
Well, Joe, if these measures are out of their normal correlations, what does that mean? How did the market perform in the past? And importantly, what will the market most likely do going forward?
Yeah, that's actually a key point Dan brought up. The Nasdaq VOLQ index actually is very highly negatively correlated with the market. It's actually 79, the negative correlation is 79, so it means that usually they go opposite directions. That's what you used to see. That's the fastball right down the middle, like Dan brought up. We actually saw a curveball at the end of August and the start of September. We actually saw the market going higher and volatility also going higher at the same time. And this, to me, set up that situation where, as a market maker, something doesn't quite smell right. What is off? And if you look back historically, you can go back to the start of this year in 2020, January 2020, we saw the volatility start to rise at the same time as the market. You go back to January of 2018, we saw the same situation, volatility rising and the market rising. So that correlation was breaking at that time, and that actually set up to two big sell-offs like we saw in February of 2018, February into March of 2020. And of course, what we see at the start of September, we had a 10% correction on the Nasdaq. So that's one of the things I can use this indicator to watch and say, where is this curveball? What does it smell right? And how, and I can use that as a tool to better predict the market.
Dan, why would this correlation break down from negative 79% to almost positive happen for traders seeking market turning points, comparing NDX to VOLQ? Is there a practical way to make an observation like that?
Yes, Jill. I think traders can definitely learn from Joe's observations today. First, we believe that VOLQ is a better measure of the index option market anticipated future up or down moves for NDX. And why? The bottom line is that VOLQ is not an insurance premium measure. Rather, as you mentioned a little bit earlier on, it mostly uses at-the-money options to calculate implied volatility. Other volatility-based measures give us a better idea of owning out-of-the-money options, which really is akin to an insurance premium measure. And second, in exchange, we function to facilitate price discovery. We simply match supply with demand. Now, in the last few weeks, we saw days when the NDX was having very aggressive moves higher with NDX options in high demand. Remember, options are used to both speculate and hedge portfolio positions. So it appeared as though position acquiring traders were present in both NDX options and NDX stocks. And this simply means option buyers contributed to the VolQ index rise parallel to the NDX rise.
And Joe, what does market scenario signal?
Yeah, so that signal just signaled an increase in volatility. Of course, we actually got it both ways. We had an increase in volatility going up and an increase in volatility going down after we saw the top. So certainly, just like Dan's talking about, what is really going on is participants are coming to the market, buying volatility, and that's leading this index higher. Now, this increase in volatility, it's just an expected measure of volatility over the next 30 days. People were saying we're expecting to see more volatility over the next 30 days. That was happening while the index was rising, while the stocks were rising, while the Nasdaq was rising. So this was telling me, okay, while people are still while the market is still going higher, people are really betting in on this this movement, which is expected to increase. And that expected movement finally culminated with a blow off top and a 10% correction.
And Dan, to wrap up, what can traders do to take advantage of Joe's analysis?
Well, first, if you're a batter, protect the plate from curveballs. And second, important for traders and investors alike to know, is that Nasdaq partnered with CME to launch a new futures contract on the Nasdaq 100 Volatility Index. VolQ futures, following all regulatory approvals, will launch on October 5th, just a week from today. Now, the futures contract will be cash settled on the VolQ index. So if you have a futures account, VolQ futures, which will go by the CME ticker symbol VLQ, will be available for trading on your screen.
All right, Joe and Dan, thanks so much. And to help further your education when examining volatility, correlation, and market moves, a wide range of resources is available on www.nasdaq.com/volq. Good trading and good luck for your favorite baseball team. We certainly need some luck in the New York sports market.